today's study circle meeting on the topic Capital Gains, Navigating Daily Practice Challenges for Chartered Accountants. And to handle this session, we have CA Deepak Chopra with us. Can I request our Vice Chairman, CA Pramod, I agree to escort the speaker of minutes and then welcome him to the floor. Members, I have the privilege in introducing the speaker. Deepak is a fellow member of Institute of Chartered Accountants of India and has graduated in Commerce from Bangalore University. He has qualified as Chartered Accountant in the year 2011. He has a strong passion of direct taxes and has been regularly taking classes for students of Company Secretary and Chartered Accountants course. He was a regular faculty member of Bangalore branch of CA for direct tax classes for students of CA final year. He has been a resource person on direct tax matters at various forums including Bangalore, Mysore, Chennai, Hyderabad, Tirupur, Davangere, Mangalore, Tirupur, Hubli, Erode, Shimoga, Calicut, Udupi, Rajahmundry, East Godavari branches. He has been resource person for session hosted by committee for members in practice. He has also been faculty for officers of Income Tax Department at the Direct Tax Regional Training Institute, Bangalore. He is presently serving as Chairman of Direct Tax Committee of Karnataka State Chartered Accountants Association. He is the founding partner in Deepak Neeraj and Associates, where he heads the Direct Tax Division. With this brief introduction, I present before you CA Deepak Chopra. Over to you, sir.
At the outset, I would like to thank the organizers, Bangalore branch, for providing me this wonderful opportunity to present myself before you. I am pretty aware that a lot of us are here to meet our CP targets, the deadline being 31st of December. But then I thought let's make an earnest attempt to gain out of the next 2 hours a little beyond mere CP targets. With this in mind, let's come together to make this an interactive session rather than a monologue wherein the session speaker comes, gives a talk and we all go home. Let's have an interactive study circle in true sense wherein we deliberate on issues and possible solutions together. So the broad framework, the broad idea for today's program, at least the way that I have conceptualized and I hopefully will be able to execute is this. That I will run through a couple of issues, about 10-15 issues that I have identified, and together with the help of the material given to you is nothing but Bare Act reproduction of the relevant section that we are going to be deliberating on today. So with the help of a simple read of the Bare Act provisions, let's see if we can get our elementaries, if we can get our basics correct today. Right? So the topic for the day is capital gains, a vast ocean with great depths. Now, it would be impossible to cover the entire provisions of capital gain in not just 2 hours, I would say, but 2 days are insufficient to cover complete a discussion on the provisions pertaining to capital gains. So we have to necessarily draft a syllabus for ourselves. And the mandate given by the organizers is that we have to stick to areas which are of practical relevance. So keeping that in mind, I have compiled a list of issues which I believe are of relevance for our day-to-day practice, hopefully. With that in mind, we begin with drafting a syllabus with a negative list. List of issues, list of items which we will not be discussing today because I believe them to be not of daily practice relevance. That would include non-resident taxation, DTAA, business reorganizations, mergers, amalgamations, demergers, Section 47, transfers not regarded as transfers, conversion of capital asset into stock in trade, slump sale, etc. We also have to bear in mind the time on hand. We have about 80-90 minutes to complete our discussion. So topics which are in their individual capacity capable of being a separate 2-hour session in themselves. topics like 54, 54F, 9B, 45-4, 50C, 50CA, joint development agreements. We've had sessions in the past on these topics, and these are topics which deserve a separate independent 2-hour session. So these are again topics that we are going to keep out of our today's discussion, out of our today's syllabus. So with this, close to 95% of the provisions under the head capital gain is out of syllabus for today. So now we know what is it that we will not cover as part of our today's session. Coming to what we intend to cover as part of our today's session, as I already discussed, we intend to cover only those issues which are of practical relevance, although here and there I will occasionally slip into areas of academic interest as well. And the mode of discussion, as I have already informed, is going to be that I am going to run through the issues. I need volunteers from the attendees over here to assist, to read through the provisions of the Act, analyze and draw conclusions. Let's have a healthy discussion and if needed a debate as well. We'll start with very simple, basic, elementary issues, very simple, easygoing examples. I hope it is visible to the people at the back. If it is not readable, then the session is not going to be of any use. There are a lot of chairs which are vacant at the front also. If you so desire, you may choose to move your location even now. Okay, so we will start with a very simple example, and for the benefit of those at the back, I will give a very slow reading of the example that's there on the screen. Mr. Investor booked a flat with Messrs. Slow Builders Private Limited via an agreement to sale dated 25th November 2021. Before a sale deed was executed in favor of Mr. Investor transferred the flat to his friend via agreement dated 27 December 2023. So 25th November 21 is when he booked the flat, and 27th December 2023 is when Mr. Investor has sold his flat. Now the question here is, the gain earned through the deal shall be taxable as income under the head capital gain or income under the head other sources, or if there is anything else, options, not taxable or taxable under any other head of income.
Capital gains.
Capital gain is the conclusion.
Yeah.
Can you help us with the analysis also, sir?
Yeah. So
How did you arrive at this conclusion?
I think there is that clause. I'm just trying to recollect, which is related to partial something. Sorry, I'm not able to articulate the name of the particular thing. Where they say that even though it's not complete, but then one part of this thing is complete. That's way. So I'm not able to relate. Apologies.
Now the charging section for capital gain is section 45. Now which would tell us that income under the head capital gain triggers only when there is a capital asset, and that capital asset should have been transferred in the relevant year for capital gain provisions to trigger. Now the term capital asset is defined under 2 clause 14 in a very wide amplitude. It's a very wide definition that we have to the word capital asset under the Income Tax Act. The definitions are there as part of your the paper that is being supplied to you. You can also go through it as and when you feel the need to do so. So 2 clause 14 defines capital asset to mean property of any kind held by an SSE. Property of any kind is something of a very, very wide amplitude. Under this agreement, Mr. Investor secures a right to get a conveyance of the flat in his name. Tomorrow, if Slow Builders fails to deliver the flat, fails to execute a sale deed in favor of Mr. Investor can sue the builder for a specific performance in the court of law. Now this right in itself is a capital asset, and when this right is assigned by Mr. Investor to his friend by way of his right, it is tantamounting to transfer of a capital asset triggering section 45, and this gain which accrues to Mr. Investor in this particular example is something which is certainly taxable under the head capital gain. It won't be income from other sources because income from other sources is a residuary head of income. What does not get taxed under other heads of income gets taxed under the head income from other sources, and there also only residuary revenue receipts get taxed under the head income from other sources. a capital receipt which is not specifically taxable under section 56 will not be taxable even under the head income from other sources. We elaborate on this in a little while in a couple of slides time, but for now, do we all concur on the conclusion that this is income chargeable to tax under the head capital gain? You all are in agreement. Great. There's a lot of judicial backing to this simple analysis as well. Because the law is very clear, I don't think we have to labor on the case law, at least for this slide. There are a bunch of extended questions pertaining to the same example. Now, the gain would be a short-term gain or a long-term gain. The gain that Mr. Investor has earned in the previous slide, would it be a long-term gain or a short-term gain? Now again, I would request members to give conclusion with their analysis. Conclusion should ideally come at the end. First, a read of the relevant law, analysis of it, and then the conclusion. Let's make an attempt. So whether what constitutes a long-term gain? A long-term gain is defined to us under 2 clause 29b. It is defined to mean a gain from sale of long-term capital asset. So what is long-term capital asset? Is given to us under 229AA. There the law tells us long-term capital asset is an asset which is not a short-term asset. Right? So now we have to understand what a short-term asset is. A short-term capital asset is defined under 242A. May I request a volunteer from the crowd to read through the provisions of 242A? We may need a mic here, please.
I'm just trying to check where is it.
242A is at page 4. It's a very long definition. We may not need the entire definition. We'll stop at where we feel we've got our answer.
Okay, thank you. So short-term capital asset, section 242A, means a capital asset held by an SSC for not more than 36 months immediately preceding the date of the transfer.
Correct.
Provided that in case of security, other than the unit listed in recognized stock exchange or the unit of Unit Trust of India, I won't go into the details of that, a unit of equity-oriented fund, a zero-coupon bond, the provision of this clause shall have effect as if the word 36 months, the word 12 months had been substituted.
We'll skip the second proviso because it talks of a transfer which has happened before 10th of July 2014, not relevant in our today's practice. We'll jump on to the third proviso.
So basically 68 number is what we are reading now, right?
Yes.
Yeah. Provided also that in case of share of a company not being
a share listed in the recognized stock exchange in India or intangible property being land, building or both, the provision of this clause shall have effect as if the word 36 months, the word 24 months had been substituted.
And there is a long explanation that follows which is not relevant for our present discussion. So we give it a pause over here. So the main body of the section tells us short-term capital asset is an asset which is not held for more than 36 months. So basically if you are holding an asset, capital asset for more than 36 months, it is a long-term asset, otherwise it is a short-term asset. And then the third proviso tells us when the capital asset under consideration is a listed security or if it is a immovable property being land and building, then for the words 36 months, we will substitute the words 24 months. In effect, what we are trying to say here is that the immovable property, which is the point under consideration here, being land and building, will be a long-term capital asset if it is held for more than 24 months. So the 24-month target is what we have given in terms of with respect to immovable property being land and building. So the question here is, the asset which is being transferred by Mr. Investor, he booked a flat and he's transferred the flat to his friend. Does it have to meet the 36-month criteria to qualify as a long-term capital asset, or should it meet the 24-month criteria to meet the long-term capital gain? 36 months? Any difference of opinion on that?
I think asset is still the building, land and building, which is 24 months. So I'm just thinking. Oh, sorry, and yeah, now I movable and immovable. Yeah, so
24 months. It's not 6 months.
24-month criteria. We also have what would seem an unrelated section for the current discussion. We have 54D and page 12. Can you just read the opening lines of 54D?
since the speaker is there with me, so I'll read volunteer. Yeah. So subject to the provision of section 2, where the capital gain arises from the transfer by way of compulsory acquisition under any law of a asset, of a capital asset, being land or building, or any right in land or building forming a part of industrial undertaking.
We'll just stop here, sir. So if anybody has noticed the change in the language here, the language used in proviso to 242A referred to a immovable property means land and building. Land and building, but we have an addition over here, which means which speaks of right in a land or building. So legislature very consciously has used different languages, different phrases for different sections, implying these are in themselves different capital assets. A right in a land or building is not same as land and building. Had it been so, there was no need for the legislature to use right in land and building in 54D and not use it in 42A. Now what is getting transferred in the hands of Mr. Investor? Is it the flat itself? No. He's got a certain interest in the flat. He's got a right to execute a conveyance deed with regards to the flat in his favor, which he is assigning to his friend. So what is sold here is not the immovable property itself. It is the right in the immovable property which is being sold by the assessee in our example, and therefore it does not fall into the third proviso to 242A. It will fit into the main section itself, which means it has to meet the test of 36 months and not 24 months to qualify as a long-term capital gain. So the gain in our example is going to be a short-term capital gain and not a long-term capital gain. It's exceeded 2 months, it's exceeded 2 years, but it has not crossed the threshold of 3 years, and therefore it is going to be a short-term capital gain. Now this is what your courts have told us. All these cases that you see on the screen are in the context of 50C. 50C also uses a very similar language with regards to deeming fiction or with regards to the transaction value on the scale of immovable property being land and building. There, in the context of 50C, the courts have analyzed the provisions of that and they have concluded that a right in a land and building is not same as land and building, and therefore right in a land and building in our illustration would not qualify for a 24-month threshold, but it would qualify for a 36-month threshold.
Sir, this in the 54D, the paragraph it says that forming part of an industrial undertaking. Whether
Forming part of an industrial undertaking is not relevant for our discussion presently. The point that I am trying to drive.
Is it continuously read or it has to be?
It has to be continuously read, sir.
But
So it has to be, there has to be a land or building or right in a land or building, and this land, building or right in the land or building should be part of the industrial undertaking for the purpose of 54D.
But in our example, whether it is part of the
No, even if it is, we are not into 54D. 54D is giving you some exemption from capital gain. We are now on the
main
question of whether the asset is a long-term asset or a short-term asset.
It's only one point. So that means we are saying that because the right is being transferred, it is short-term assets. Now I'm going to the definition of the right per se. So that means if, let's say, if I buy a property, if the ownership is given to me, right, when I transfer that, then it becomes a capital asset. But then before the ownership is finally transferred or the asset is complete, it is just a right transfer. Is that the differentiation which I'm trying to make here?
Before I get the possession of the property,
Possession of
before
the
I become
property.
the owner of the property, what I own is not the property itself, I only own a right in the property. You're right, sir.
Okay, so the position is what makes the difference between the
We
right
had an
and-
occasion to address possession versus ownership in a couple of slides time. If I may request you to park this question, pause this question for a while, we'll probably be answering your question. Okay. Another connected question with this. Would TDS and the 194 IA be applicable on consideration paid to Mr. Investor on the same transaction? Do I have to do TDS? Let's look at 194 IA. What is the language used over there? 194 IA is at page 14. Any volunteer?
If no one, then
We'll give
Give chance,
opportunities
chance.
for this. Or else we'll pick random names from the attendance register. We have one. Thank you, sir.
Any person being a transferee responsible for paying to a resident transferor any sum by way of consideration for transfer of any immovable property other than agriculture land shall at the time of credit of such sum to the account of the transferor or at the time of payment of such sum in cash or by issue of check or draft or by any other mode whichever is earlier deduct an amount equal to 1% of such sum as income tax.
So 194 IA, the trigger is whenever there is a transfer of immovable property, and immovable property is defined as part of explanation to 194 IA. If I may request you to read that as well, sir. Explanation to 194 IA, clause B.
Immovable property means any land other than agriculture land or any building or part of a building.
So very similar in its language to what we saw under 242A. Here again, the reference is only to land or building. It also refers to part of the building, but it does not include within its scope a right in a building or a right in a land. A right in a movable property transferred by necessity, in my view, should not trigger 194 IA, and therefore there is no requirement to do TDS on this transaction that we just discussed. Although in practice it's a different matter that we take a safe stand of TDS is not my money, it's anyways somebody else's money. I pay 100 to the seller or I pay him 99, I pay 1 to the government, doesn't make any difference to me. So normally the stand taken for all TDS decisions is deduct tax. Even if it is not applicable, deduct tax. Let him claim his income tax refund. But then the legal conclusion in my mind would be TDS is not required on this transaction. Okay. Having touched upon 242A, I thought it would be wise to summarize the various time thresholds that we have in the 242A. So in the 242A, if the asset is a listed security other than a unit of mutual fund, or if it is a equity oriented mutual fund or unit of a UTI, or if it is zero coupon bond, the threshold that is given to us is 12 months. So if any of these three assets are held for more than 12 months, it qualifies as a long-term capital asset. Unlisted shares and land or building that we just saw, the threshold given to us is 24 months, and for all other assets it is 36 months. Now all other assets would include units of debt fund, units in REIT, it would include unlisted securities other than shares. Unlisted shares, the threshold given to us is 24 months. Unlisted debentures, it would be 36 months. Sorry? Gold and jewelry, all other, any other capital asset which does not fit into the first and second row would fit into the third row, and therefore the time threshold for us would be 36 months. Listed on a recognized stock exchange. Recognized stock exchange, there is again a definition that I have not produced it over here. It refers to a recognized stock exchange, that is your BSE, NSE India, not a stock exchange outside India. So, a valid addition to the discussion, a security listed on, let's say, New York Stock Exchange will not fall under 12-month criteria, it would fall under 24-month criteria, unlisted shares. Thank you. Thank you, sir. Thank you for the addition. We'll gradually try to scale up our knowledge and the complexities of the problem at hand. Mr. Owner had purchased a flat on 1st October 2021 for a consideration of rupees 75 lakhs. He entered into an agreement to sell on 25th September 2023 and received the entire sale consideration of rupees 95 lakh. The sale deed was executed and registered on 5th October 2023. Comment whether the gain from sale in the hands of Mr. Owner would be short term or long term.
It's long term.
Let's go in a slightly methodical manner. Now the criteria that I have to meet is 24-month criteria or 36-month criteria?
24 months.
24-month criteria. What I am selling here is a flat. Flat is a immovable property, it is land and building both. Very clearly, if I hold it for more than 24 months, it is a long-term capital asset. Now I bought it on 1st October 21. There is one transaction that is happening on 25th September, which is within the 2-year period, and there is another transaction which is happening on 5th October, which is outside the 2-year period. The question here is, when does the transfer take place? Upon entering into the agreement to sale, that is on 25th September, or upon executing the sale deed, that is 5th of October. How many in favor of the statement that the transaction happens on 25th September? Because I have entered into a binding agreement to sale, I have also received the consideration. 25th September, the sale is complete, the transfer has happened, it is a short-term asset. How many in favor of 5th October as the date of transfer? Balance field is exempt. The correct answer would be 5th October, for the reason being, on the date of agreement to sale, it's only an agreement for future sale. There is no transfer that happens. The conveyance of the immovable property happens only upon execution and registration of the sale deed. That is when the transfer happens for the purpose of Income Tax Act as well. And that is the date that we will count for the purpose of computing the period of holding. And because it falls after the 24-month criteria, this is a long-term capital asset. The gain is a long-term capital gain.
Now, how about part performance of the contract under Section 53 of the Transfer of Property Act? Would it not attract here?
That's my next slide, sir. So this conclusion that we just drew has got a post of judicial support also. Now coming to your point on 53A of Transfer of Property Act, that answer is in this slide. So this is a continuation of the previous example. The same transaction, the flat is bought on 1st October, agreement to sale made on 25th September. One additional information given to you over here is that on the date of agreement to sale, the possession is handed over to the buyer. The possession of the flat is handed over to the buyer, and the sale deed is subsequently executed and registered on 5th October 2023. Comment whether the gain is short-term gain or long-term gain. How many in favor of short-term? And what is the basis for that conclusion? If anybody could elaborate. Possession is given. The fact that possession is given, what exactly does it trigger, sir?
Definition of transfer.
Definition of transfer. Thank you, sir. If I may request you to read the definition of transfer. Definition of transfer is at page 8.
You want me to do the entire problem?
We will read the relevant ones, sir. We
Okay.
will start with the header and we will jump on to clause 5.
Okay. Transfer section 247, class 5. Any transaction involving the allowing of the possession of an immovable property to be taken or retained in part performance of a contract of the nature referred to in section 53A of the Transfer of Property Act 1882.
So 2 clause 47 defines transfer. Transfer in relation to a capital asset includes, so it's an inclusive definition that we have under our Income Tax Act. It includes a transaction referred to under section 53A of Transfer of Property Act. Now transfer of 53A of Transfer of Property Act would give us a trigger to say that on what occasion a transfer is concluded. So that trigger will tell you that there should be an agreement in writing, and in pursuance of such agreement in writing, the seller has parted with the possession of the property, the possession has passed on to the buyer, and the buyer has paid the consideration in full or in part, or is willing to pay the consideration as per the agreed terms. When all of these conditions are cumulatively satisfied, section 53A of Transfer of Property Act is triggered, consequence of which 2 clause 47 is triggered, and there is a transfer, and therefore there is a capital gain. Anybody who want to differ from this conclusion? Any other conclusion?
The part payment means what percentage? I have given 10%.
Here it is full payment, and in any case, even if it is part payment, 53A is triggered. In fact, even if there is no payment, but possession is transferred, 53A is still triggered.
The capital gains cannot be calculated, no, because at the agreement date we are not given anything.
I have a separate slide on that. I will come back to this issue. So the query raised over here is, the consideration is paid only in part. So why should I pay tax on the full? I address this in a separate slide dedicated for this question. A very valid question.
Yes.
I'll just request you to pause it for a while. Now this conclusion that we drew was valid and right until a couple of years back. Until Supreme Court came up with its judgment in the case of Balbir Singh Maini, wherein Supreme Court concluded that any conveyance of an immovable property is not possible unless and until the deed under which the property is sought to be conveyed is stamped and registered. An unregistered document, even for the purpose of 53A, will not convey any property from the buyer to the seller, or rather from the seller to the buyer. It will serve no purpose other than serving as an evidence in a suit of specific performance. So unless and until there is a registration that is done, a transfer is not effected even if the possession is handed over. So therefore, under the law as we now understand, post the Supreme Court judgment in Balbir Singh Maini's case, there is no transfer even despite the fact that there is a transfer of possession. There is no transfer as on 25th September. The transfer happens only on 5th of October when the sale deed is executed and registered.
What is the difference between the sale deed and deemed sale deed?
I am sorry sir, I am not aware of this concept of deemed sale deed. If you can help us.
It's a transfer of, as per the Transfer of Property Act. Possession given and 90% of the amount has been given.
That is what is a 53A case.
Yes.
That is what, okay, maybe in common language was referred to as a deemed sale deed. But then Supreme Court now clarifies to us, Supreme Court's conclusion is out of a detailed analysis of the Transfer of Property Act, Indian Registration Act, and host of related regulations and rules. Supreme Court concludes that even 53A is not complete unless there is a registration.
So that means the sale deed execution date, which is the 5th of October, is the final date.
And the only thing which I was just trying to check in my mind was the earlier part which we discussed related to the right transfer. So because we are saying the 5th October is the date because the sale deed executed, it won't also be covered with the right transfer, because let's say if it was done on the 25th of September when the possession is handed over and it is not a completed executed deed.
The only right that an unregistered agreement to sale conveys to the buyer is a right of specific performance, nothing more, nothing beyond that. That is the only right that a buyer gets under an agreement to sell, an unregistered agreement to sell.
That means 100% consideration has to be given.
Not necessary, sir. Consideration is a private arrangement. I may transfer the property to you with a promise that you pay me after 1 year also.
When the right date comes, only no conditional deed should be there.
Sir, we have a slide on conditional transfers also.
So only the one point, if it was not registered, let's say 5th October was not a date, and let's say it was 25th of September only just transferred to some conveyance, so then it will be covered into the right transfer and not the asset transfer. Is
There is
that
no
right?
transfer, is what I am trying to say.
Okay, no transfer at all.
From the point of view of Mr. Owner, the seller, there is no transfer at all. The transfer fructifies only on the date of execution and registration of the sale.
Sale deed is a conclusive.
I will say yes for the time being, but then I will revisit this in the next year.
But there is a specific provision which allows you to consider that as a possession is given, sale agreement is there.
This is precisely what we read, sir. 2 clause 47, sub clause 5, referring to
Supreme Court
53A.
decision.
But Supreme Court says that 53A will work only when there is registration. Income Tax Act has not been amended, but the reading of the law has been amended by the Supreme Court. Okay. Now let's take this a little more further. Mr. Owner sold his flat to Mr. Buyer for a consideration of 1 crore. Following timelines are provided. Unregistered agreement to sale executed on 25th Feb 2023. Entire consideration paid and possession transferred. Do we have any trigger over here? No. We just concluded. Because it is unregistered, there is no transfer. Sale deed is executed on 25th March 2023 and presented before the sub-registrar for registration on 28th March 2023. We are normally accustomed to be seeing that the sale deeds are also executed in the sub-registrar's office. The parties to the contract meet at the sub-registrar's office and the signatures happen at the sub-registrar's office, but that's not a legal mandate. I can have my signatures done in CCD, Cafe Coffee Day, and I can present it to the sub-registrar on a future date as well. Perfectly fine. So sale deed is executed on 25th March. It is presented before the sub-registrar on 28th March. 28th March, sub-registrar servers are down. On account of technical issues at the office of sub-registrar, the document could be registered only on 1st April 2023. But the question here is, what is the date of transfer for computing period of holding in the hands of Mr. Owner?
Because there is a reference of registered sale deed, so that means registration.
So we have multiple dates over here. First, let us rule out the obvious ones. 25th Feb 2023, the date of agreement to sale, we have just concluded, has no relevance. Sale deed execution date 25th March. Sub-registrar was presented for registration on 28th March. He finally registers it on 1st of April. So which of these 3 dates are relevant for our capital completion?
First April.
Even like the Supreme Court's case, even 25th February itself is like now triggering point. Because the registration happened on 1st April.
But the agreement to sale is unregistered. So there are 2 documents. Agreement to sale is a separate document which I have never registered. And then there is a sale deed which I executed on one day, presented it on another day, and finally got registered on
That's all I agree, but the possession has been given on the day of that unregistered agreement day itself. So that means 53A figures, no?
The 53A will trigger only if there is a registration. So there is no
registration happened after.
But what is registered? What is registered is the sale deed, not agreement to sale. Different documents.
21st March will be 20th.
21st March, there is no 21st, 25th March.
25th March.
Yeah, 25th March.
If you read section 54 and section 55 of Transfer of Property Act, the essence of these 2 provisions is no agreement to sale or sale deed will take any effect for transferring of immovable property would take any effect unless and until it is duly stamped and registered. So registration of a document is a compulsory mandate under Transfer of Property Act for any transfer of property to take effect. So,
Indoors not being presented, then it can be considered even 28th March as a date of execution. Because it's a technical default also looks right.
So the sub-registrar acknowledges that it was given to me on 28th March, I could not register, there was some issue.
Yes.
I did it on 1st April, so 28th March can be taken as a date.
Why should I lose it?
Why should I suffer because of the system errors of the... They already suffer a lot because of IT related issues, IT board issues. Why should I suffer there also?
CA executed on 25th March itself. Now 53A comes here, right? In the earlier situation, it's an unregistered agreement. Now this agreement is got registered and it was executed on 25th March.
Correct.
So then 53A triggers and date is 25th March 2023 itself.
The registration.
But registration is happening on 1st April. So should I look at 1st April,
Supreme
25th
Court
March?
said no, as long as the document got registered only, the 53A comes into play, right?
Supreme Court stopped at saying that if it is not registered, it has no value.
Sir, it is registered with effect from 25th March.
Precisely what Section 47 of Registration Act tells us.
Yes.
Section 47 of Registration Act tells us any document which is registered will take effect not from the date of registration but from the date of execution. So even if it is presented late, even if it is registered late, it will always, the transaction will always date back to its date of execution and not date of registration. So therefore, in this case, the date of transfer is going to be 25th March and not 1st of April. And this is precisely what Delhi High Court and Gujarat High Court has told us in the case of Ghaziabad Engineering and Arundhati Maharashtra transfer. Okay, so all these while we've been looking at the transaction from the point of view of the buyer, or rather from the point of view of the seller. Now let's change our client. Let the buyer be our client for a while, and let's understand or analyze the same transaction from the point of view of the buyer. The transaction details remain the same. The question here is, what is the date of purchase for computing period of holding in the hands of the buyer? For the buyer, the period of holding would start from what date?
It is an execution date. Execution date.
Sale date, 25th March.
Yes.
So it has to be in sync. The transfer is happening on 25th March. Logically, even the buyer becomes the owner on 25th March, and therefore 25th March is the date from when his meter or period of holding would start. And any different answer to this?
25th February.
25th February. Any analysis, any reason for this?
The transfer is in the account of seller, not in account of buyer. So what once he give possession, that will date to the
We just read definition of capital asset. Capital asset means property of any kind held by a necessity. Okay? I'm emphasizing on the word held by a necessity. We will also once again read 242A, which basically gives me talks on the period of holding. 242A, short-term capital asset means a capital asset held by an SCM for not more than 36 months immediately preceding the date of extension. Throughout the capital gain provisions, if you see, the emphasis is on holding the asset and not owning the asset. Now the buyer becomes the owner on 25th March, but he is holding the asset since 25th of Feb. Now what do you mean by hold? The dictionary meaning of hold would be to carry something in your hands, to have a physical control over something. That's holding the asset. And therefore, for the purpose of computing the period of computation in the hands of the buyer, his meter will start from 25th Feb and not 25th March. Again, a host of judicial pronouncements supporting this. I just quoted two High Court judgments, but there's plenty even in our Karnataka High Court and Railroad Tribunal experience. So the period of holding would start in the case of the buyer not from the date of registration, not from the date of sale deed, but from the date of agreement to sell in this case, that is 25th Feb 2023. Anything that somebody wants to add, please?
Does it mean that he is not holding at all?
Next slide.
The agreement to sale, he has not given 100%
payment, he may be holding.
I'll come to that also, sir. That's also covered. A simpler example first. So I think this covers, this answers your question. On the part of non-payment of the entire sum, this slide should answer it. Mr. Lucky applied for a plot with State Householding Development Board. The sequence of events are as under. Jan 2006, he has made an application. April 2006, by draw of lots, his application is accepted and he is paid the first installment. April 2007, there is a site which gets allotted to him, possession is handed over and he pays the second installment. April 2010, a sale deed is executed in favor of Mr. Lucky and the final installment is paid by him. May 2010, the plot is sold by Lucky. The question here is whether the gain on sale of the plot is long term or short term, or to further refine the question, what is the purchase date? What is the date from where I will start counting the period of holding in the hands of Mr. Lucky?
April 2007, because he hold.
April 2007 or April 2010?
7.
So you answered your own query, sir. So the payment is irrelevant. The day on which he holds the asset is what is going to count, and it is from there that I have to start my meter, the count from period of holding. This is the precise set of sequence of events, only the dates changed, that Delhi Tribunal had to address in the case of Jitendra Mohan, and there again the conclusion was payment is not what you are going to be guided with. You are going to be guided with the date of holding, and the date of holding here is April 2007.
Indexation will come.
Next slide.
So for handing a possession,
In fact, this is something which is acknowledged. This is not in debate also any longer. This is something which the CBDT acknowledges in its circular number 471 also. Although the circular is in the context of allotments made by Delhi Development Authority, but then by way of a subsequent circular under Circular 672, they have said that any such allotment scheme which is similar to the scheme which we deliberated under this 471 circular, the benefit of 471 circular would be available to those allotment schemes also.
so what should be the document for having received the possession? A simple letter.
They give you possession certificate.
Possession
They
certificate.
give you a possession certificate. Date of allotment versus date of possession. For computing period of holding, what is relevant? Courts have gone on to say it is the date of allotment. I'll pick one case out of this list. We will analyze the facts of it and then we discuss this again. So this is a case of Srimati Lata G. Rohra before Bombay Tribunal. The sequence of events is on your screen. I'll read it out. 1993, agreement to sale was entered into with the builder for purchase of flat. 1997, construction was complete. 1998, sale deed executed and registered in favor of the SCM. The issue before the ITAT is what is the year of purchase? Rightly or wrongly,
97.
rightly or wrongly, the conclusion drawn by the courts, it's not just a standalone case of Lataji Bora, there are a host of other cases. You find bunch, at least find 2 dozen cases with similar conclusions. The court has concluded that it is 1993. Something that I personally don't subscribe to, something I find it personally difficult to digest. To explain this better, let's adopt this logic and try to apply it in a much simpler transaction. Let's say in the month of March 2023, I approach a jeweler. I give him an order form, I make him an advance. We agree on a price, we agree on a design, and full consideration is paid by me in advance. The jeweler manufactures the jewelry and delivers it to me in April 23. So what would be the month of purchase?
That is March only.
Logically, March is what the courts have told us. I would say that is a stretched view of or the principles of being held. Now to say that I held the jewelry in the month of March would be absurdity. In the March, the asset did not exist at all. The asset came into existence in the month of April. How could I have held it in the month of March? Then, rightly or wrongly, that's what is happening over here as well. No, 1993, I've just entered into an agreement. The property got constructed in 1997. When the property itself is coming into existence in 1997, how could I have held it in the year 1993? But then, again, as I said, rightly or wrongly, this is what courts have held. It's beneficial to your SSEs. You have an option to adopt it, advise your clients that this is a benefit available to you, make use of it, but with a caveat that this might not be the final position. I know it's a 2008 case law. It's a very old case law and still stands undisturbed, but then you never know. Right? Coming to your query on the year of indexation with regards to payments made. That's a Bombay Criminal Judgment. Charanveer Singh Jolly, 1993, agreement for purchase of house entered into, booking amounts paid, 94 to 96, balance installments paid by the buyer, 2005, the house is sold. The query is how to compute cost. What the SEC did in his return of income is, he indexed the entire cost to the base year as 1993. What the assisting officer contended is, no, 93 is too early for the entire cost to be indexed. You should index the cost over the years of payment. For this, what he said, I will take the 1993 payment as cost of acquisition and the subsequent payments I take it as cost of improvement. Again, a view which I would not personally subscribe to, but then the court is again concluded in favor of this. So these are judgments available to our benefit. Make use of it with caution. So the tribunal went on to hold. The basic idea of bringing the principle of indexation is to give some sort of protection to the SSE from the onslaught of inflation. The effect of inflation could be measured only with reference to the total cost of acquisition of a property. If the effect of inflation is measured with the payment of the first installment, the whole scheme becomes ridiculous. It is to be seen that the factor of inflation is not with reference to the payments made by the SSE, but with reference to the value of the asset vis-a-vis the cost of acquisition of the sale consideration of the property. Therefore, in the instant case, the cost of acquisition of the house property for the purpose of long-term capital gains computation was the total cost incurred by the SSE and not the first installment value as determined by the lower authorities. Now, this is something which you will find in a bunch of more cases also, wherein the courts have gone on to hold. See, payment is a private arrangement between the parties. Payment can be in advance, a transaction can be for cash, that is paid as and when the transaction is executed, or a transaction can be on credit. So the year of payment is not material, the year on which you hold the asset is what has to count for the purpose of indexing asset.
So, did you see any scenarios or situations where the AO has challenged not the case law, but these kind of situations, because practically that's how I've been doing that indexation will start from the payment.
So you've been indexing over the years of payment?
Yeah.
But that's a happy situation in the officer. No, why would he dispute that? Officer would dispute your workings only if you are taking the entire indexation in year one. If you are deferring your indexation over the years, if you are spreading it over the years, you are reducing your cost. It's a happy situation for the department.
No, my question was that in the previous one, where it's a total cost get charged at the start of the year, whether AO has disputed in your practical experience, where the total costs get the start from the start of
In
the
my
year.
practical experience, I have never applied this. I have also, like you, always indexed it over the years of payment. That is what logically sounded acceptable to me, not in terms of legal interpretation, but in terms of logical acceptance. I felt that is more defendable and reasonable with the department, and that is what I have been adopting. But then you have the judiciary on your side, face the Another illustration, we'll quickly run through this. Srimati Rajrani Devi, that's an SSE who stood before Patna High Court, sold lands wide execution of sale deed which were duly registered in year one. The payment of consideration was however due, and the sale deed stipulated that the property would be conveyed only upon payment of entire sale consideration. And the executed documents were also withheld by the seller. the payment was made and the sale deed was handed over in year 2. What would be the year of transfer? So year 1 there is a sale deed which is executed and also registered with the condition that the buyer will make full payment and then take delivery of the sale deed. The sale deed was withheld by the seller. And this event of payment and handing over the sale deed happened in year 2. So what would be the year of transfer in this case?
So technically, the title would have transferred as and when the registration took place. Irrespective of withholding of the paper, doesn't make any.
So what court concluded here is, the transfer is not an unconditional transfer. The transfer being a conditional transfer, upon registration, it only reflects an intent of the parties to convey the property. But the intent of the parties has to be looked at with the actions of the parties also. When does the transfer actually take place? The transfer actually takes place when the full amount is paid and the property documents are handed over to the buyer.
So in a sense, it's not a sale deed, it's an agreement for sale.
It's a sale deed. It's a sale deed with the stipulation that this will take effect only after full payment. So the intent of parties is to be respected as what this case law tells us. The parties intend to conclude the transaction on a future date, and if it is attached with some conditions, then those conditions have to be respected.
There is a figure in the books of registered sub-register office.
Sub-registrar will report it in year 1. Sub-registrar will report it in the year of registration.
Technically, the owner of the
Buyer will also do TDS in the year of registration only. So there will be a mismatch. Your ITR and the 26 AS and the TIS.
In the condition, the second payment has not been made at all. It is an invalid then.
Correct. So that's what even the court said. What if the now in this case the buyer made the payment and the transaction went through, all is well. What if he had not made the payment? What would have happened? Legally the property would have fallen back to the seller. So therefore the transfer completes only when the conditions stipulated in the transfer deed are complete. Okay. Now we'll come back to 242A here. Period of holding. We'll spend some time over here. I hope this will be of interest to all. Mr. Investor bought shares in a listed company on 28/12/2023 and sold the same in December 2024. Comment whether the resultant gains are long-term or short-term in the following scenarios. Scenario A, the date of sale is 30th December. B, 29 December. C, 28 December. Please note, 2024 is a leap year comprising of 366 days. We'll get a basic right first. 242A gives us the time thresholds. Normally for assets it is a 36-month criteria, but then for listed shares it is a 12-month criteria. So when is 12-month criteria accomplished? December, all of us are happy. Looks like long term only. 29th and 20th is somewhere there was slight confusion. All are long term. Okay. Then let's analyze with the reading of the law. Okay. 242A, I have it on the screen. I've just broken it down into phrases for ease of reading. Short term capital asset means a capital asset held by an SSC for not more than 36 months, 12 months in our context, immediately preceding the date of its transfer.
So the fundamental unit is a month, it's not number of days.
First things first, let's get a basic right. The requirement here is completion of X number of months. The number of days are totally irrelevant. So it's a leap year with 366 days or a normal year with 365 days, makes no difference. Okay. So far so good. Next. The requirement is to complete
A month.
12 months. A month. What do we mean by a month over here? The term month is not defined under the Income Tax Act. Therefore, we'll have to take assistance under General Clauses Act, wherein we are told month generally means a English calendar month. Right? It's not a period of 30 days or 31 days, it is a calendar month. So the requirement for an asset to qualify as a long-term asset is what? Not more than 36 months means what? If it is held for 36 months or if it is held for 12 months in our context, would it be short or long? 12 months is not more than 12 months. 12 months and 1 day is more than 12 months. So even at 12 months it is going to be a short-term capital asset. Or in other words, in simpler words, for an asset to qualify as a long-term asset, it has to be held for more than 12 months or more than 36 months. Right? When is this 12 month achieved? When is this period of 12 month complete? So I bought it on 28th December 23. When do I complete 12 months? 29th 12. I complete a period of holding of 12 months on 27th December 2023. 27th December is when I complete a 12 month period. I buy on 1st of Jan. I sell it on 31st December. Have I not held it for 12 full months?
But it is not more than
The requirement is to hold it for more than 12 months. So 27th Jan I have held it for 12 months. 28th Jan I have held it for 12 months and 1 day, which is more than 12 months. And the requirement is to achieve the target immediately preceding the date of the transfer. I have to achieve this 12 month 1 day target, not on the day of transfer. I have to achieve it before the date of the transfer. Therefore, 27th December I have completed 12 months. 28th December I have achieved the target of more than 12 months. Any transfer made on or after 29th December is going to be a long-term gain. So 29th and 30th is going to be a long-term gain. 28th December is going to be a short-term gain. This is the most widely accepted, adopted interpretation. Income tax utilities, wingman utility will all tell you 29 December long-term, 28 December short-term. But interestingly, we have this Delhi High Court case in the case of Bharti Gupta. And Delhi High Court had some very interesting observations to make on this piece of law. Delhi High Court said, see, number one, for the purpose of computing the period of holding, you will include the date of transfer and the date of purchase, both days. And there is no requirement here to hold for 12 clear months. Like our AGM notice, 21 clear days, there is no such requirement. Even a fractional day will be counted as one complete day. Therefore, the moment the assessee holds it for a period of 12 months, the very next moment he crosses 12 months. Therefore, analyzing and collating all of these observations, Delhi High Court concluded in that case that if he is holding it for 12 months and transferring it the very next day, it is a long-term asset. If he is holding it for 12 months on 27 December and if he is transferring it on 28 December, it is a long-term asset. Delhi High Court, Income Tax Department, utility does not follow this approach. But then this is a High Court judgment. This is not even a tribunal judgment, more than a decade-old judgment, still standing undisturbed. Use it with caution.
Not more than the previous.
As I said, most widely accepted and adopted interpretation is 28 December short term. But if Delhi High Court is telling it is long term, and if you are stuck in a scenario where you are missing out on some benefit by a mere 1 day, then maybe you can take recourse to this judgment, but of course all disclaimers to your credit. This is going to be a definite litigation. Okay. Sale of constructed building. Mr. Hardworker bought a plot of land on 1st April 2022 for a sum of rupees 50 lakhs. In financial year 23-24, he constructed a residential building on the plot at a cost of rupees 25 lakh. On 5th April 2024, he sold the property for a price of 1 crore. Is the gain long term or short term?
separately.
Land can be long term for building.
So it is both long and short. This is what even the High Courts have told us, including our Karnataka High Court in the case of CA Deepak. The courts have observed that this is a case of a sale of a composite asset. So there are two assets. There is a land, which is an independent capital asset in itself, on which you have a building, a superstructure constructed and sold. Now the building is being held for less than 24 months, and therefore it is going to be a short-term asset, and the land being held for more than 24 months is going to be a long-term capital asset. How do you actually compute it? For that, courts have told us, on a rational, logical basis, split the sale consideration. Split the sale consideration between sale consideration for land, sale consideration for building. Now, how do we achieve it? To my mind, logically, there are two ways out. Option one, take the registered values required. Value will certify land value this much, building value this much. Adopt those values, do your computation, close the case. Option two, a more practically achievable solution. Find out the guidance value of land alone. Find out the guidance value of the property with the building. Take that as base and split the sale consideration. Right?
Once we take this improvement, building is an
Can
improvement.
there be a third approach to it? Can I contend that what I have sold is a constructed property? I have sold a house property which I acquired in the year 2022, and I improved by constructing a building in 2023 or whensoever. Take the cost of land as cost of acquisition and cost of building as cost of improvement. I have practically applied this. We have seen through assessments also, but then I don't find any judicial blessings on this approach. Right? So, with a word of caution, as I said, department has never, disputed this approach, but then I don't find any judicial backing to this approach as well.
Why means we can't sell land separately, building separately. Once we got constructed, as a whole we have to sell. We have to take that as an improvement only.
Correct. I'll take a minute's break. There's somebody who's been constantly trying me. I'll just attend this call in a minute and I'll be back. And then I'm really sorry. So I hope there's no emergency. Sale of a furnished flat. Mr. Employee bought a flat at a price of rupees 65 lakhs in financial year 22-23. In the same year, he spent 5 lakhs on house furniture and fittings. In April 24, he sold the flat for a consideration of rupees 85 lakh. In computing short-term gain, can Mr. Employee claim deduction of rupees 5 lakh for the expenditure incurred on furniture and fitting? Can I say sale consideration 85 lakh, cost of flat 65 lakh, less cost of furniture and fitting 5 lakh? That's a cost that I have incurred, no?
It's for movable assets.
Courts have told us no. Cost of acquisition is available only in respect of a capital asset. And the definition of capital asset, if you want to read on, would exclude personal effects of movable nature. So furniture and fittings are meant for personal consumption, it's meant for personal use, and these are movable in nature, and therefore they are not capital assets, therefore they won't have any capital, they can't be, the cost of such assets which are not capital assets cannot be considered for the purpose of computing capital. So could this have been handled in some better way?
Sale consideration can be non-disciplinary.
Again, applying a logic from our previous slide, a stand could have possibly been taken to say sale consideration is for sale of composite assets. There is some consideration attributable to sale of land or sale of flat, and there is some consideration attributable to sale of furniture and fitting. Furniture and fitting portion keep it aside and proceed with the capital gain computation for sale of flat. That would have been a better approach in my mind as well. Silver utensils, are these capital assets? Again, like in the case of furniture and fittings, silver utensils are not capital assets. So any gain that you earn from selling silver utensils are tax free. Wouldn't it fall under income from other sources then? It's not capital asset because it's personal effect of movable nature, agreed. But then wouldn't it fall under income from other sources? No, because we concluded in our very first example that income from other sources will tax, it's a residuary head only for revenue receipts. Capital receipts which are not specifically listed under 56 cannot be taxed even under the head income from other sources. And there is a good amount of judgment also. Date for transfer of shares. Mr. Shareholder sold shares in Slow Private Limited. The timelines of events are as under. 5th March 2024, entered into an agreement to sell. 10th March 24, received sale consideration. 12th March, executed share transfer form, that is SH4, and handed over the share certificate. 15th March, share transfer forms lodged with Slow Private Limited for recording the transfer. 25th March, the board approved the transfer. 27th March, the members' register was updated. 1st April, fresh certificate bearing the name of the buyer issued. And this timeline, this sequence of event, what is the date of transfer from the point of view of shareholder? That's the normal procedure, no? You first enter into an agreement to sell, then some consideration is transacted, then you execute a share transfer form, deliver the share transfer form and share certificate to the buyer. He will then take it to the company, he will lodge it with the company, the board of directors have to approve. Once approved, it has to be updated in the members' register, and then a share certificate is issued to him. In this entire series of events, what is the date of transfer in the hands of Mr. Shareholder, the seller? SH4.
Date of entering in the shares register.
Date when the members' register is updated, that is 27 March 2024. I would want to support this argument with a statement that is, unless my name is entered into the shareholders register, I don't be a shareholder of the company. I get no rights, no privileges. I can't attend the AGM meetings, I don't get the AGM invites, I don't get dividend, I'm not entitled for bonus. So, recording of my name in the shareholders register is an important event.
But in the share register,
That's one possible answer. I'm not saying that's the correct answer, that's one possible answer. Signing date of SH4. And what is the relevance? Can you please elaborate on that?
Because the share transfer, the rights.
That is the share transfer form where the transfer happens. So,
Yeah, that is the person who will transfer and transferring both will sign and they will agree for the transferring the shares.
okay.
So that is the.
But what if board subsequently disapproves this transfer?
They have to perform one more.
Okay. Any other answer over here? I was expecting multiple answers for this.
the members' register is updated, but we can effective from personal.
Date of approval is.
Date of board approval is relevant, and that is when the share transfer happens. Now, this is the case which came up before Madras High Court in the case of Ramaswamy. In detailed analysis of this issue is being done over there. And there the Madras High Court has concluded that between the transferor and the transferee, between the buyer and the seller, the date of conclusion of the contract is the date when the share transfer form is executed and the shares are delivered to the transferee, to the buyer. From there on, all these events, all these transactions, the transferor has no role to play. He's done his part in the contract. He's transferred his right to the buyer to get a share certificate issued in his name. Rest are all only procedural and administrative tasks which the transferee does by himself independently. But at the same time, the court also acknowledges the fact that the transferee does not become a shareholder unless and until his name is updated in the shareholders register. And beautifully, Madras High Court reconciles the two to say Between the transferor and the transferee, transfer is complete on the date of execution of share transfer form and delivery of share certificate. Between the transferee and the company, the transfer will take effect from the date on which the shares are updated, the names are updated on the shareholder register. Both are having company law and IT. Now this issue again came up before Kerala High Court almost a decade later, wherein further refinement into this happened. Now consider a scenario where share transfer form is executed today, but the shares are delivered tomorrow. Now what date do we take? The date of execution or date of delivery? Madras High Court says, "Itna complicate karne ka zarurat nahi hai. You don't need Companies Act for this." What is this? What you're transacting is shares. Shares are what? Shares are immovable property. These are goods. So please refer to Sale of Goods Act. Now Sale of Goods Act, section 20 will tell you, with regards to sale of identified property, identified goods, which is unconditional sale, the sale concludes when the contract is made. So date of execution of SH4 is the date of transfer. The delivery can happen at any point of time, the payment can happen at any point of time, but for the purpose of computing capital gain, the transfer date is the date of executing the share transfer. This is with regards to unlisted securities. With regards to listed securities, what is the procedure? I want to make a transfer, I call my broker or I log into my broker's portal, I place an order, the broker will enter it in the terminal. If there is a match in the exchange, the transaction is executed, but the shares are delivered to me the next day. We are presently under T+1 cycle. A couple of years back we were under T+2 and very shortly we are expected to fall under T+0. So the transaction date is today, but my Demat account is credited tomorrow. So what is the date of transfer? Today or tomorrow? The date of transaction or the date of credit to my Demat account? Date of transfer, absolutely no disputes on that. This is settled by CBDT itself way back in 1995 by way of Circular 704. CBDT is clarified that it is the date of execution of the contract which will count and not the date on which the shares get enter or exit your Demat account. Interest as deduction for computing capital gain. Can I claim interest as cost of acquisition? So I bought a property for 1 crore. I bought it on loan, paid 10 lakhs as interest to bank, and now I am selling it for 1.5 crore. Can I say my cost of acquisition is 1 crore 10 lakh, or would I have to restrict myself to 1 crore?
So it depends if the interest benefit has not been taken. So
if the interest benefit has not been taken elsewhere, absolutely no troubles. Interest in the commercial sense is cost of acquisition. That's a cost that I incur to buy a property. A well recognized commercial principle even for tax purposes. Interest can be claimed as deduction, but as Sir rightly pointed out, it should not have been claimed as deduction elsewhere. So if I have claimed interest cost as deduction under section 24, I cannot have a double deduction. But this was by way of court judgments. Earlier there was some dispute. There was Karnataka High Court which said double deduction is not allowed. Delhi High Court said double deduction is allowed. But now this is something which is incorporated into the Act itself.
So when you're saying in the Act, because earlier when I was doing this thing, I was referring to some case laws and judgments. So now where...
Case law, Karnataka High Court Maitri is against you, sir. If you are handling SSC in the state of Karnataka, double deduction was not allowed even before the Act was amended. Okay, hold on.
Difference amount can be claimed.
Differential can be claimed. So out of 10 lakh, I have claimed 2 lakh, balance 8 lakh can still be claimed. Mr. Optimist sold shares of a startup to Mr. Doubtful for consideration of rupees 100 crores. The terms of the sale provide for immediate payment of 50 crores, year 1, and balance payment of 50 crores in year 2. I think this was a doubt initially you had. Contingent consideration. So the balance payment is to be made in year 2, subject to achievement of certain milestone. Mr. Optimist wishes to offer to tax only 50 crores in year 1 and balance 50 crores in year 2. Comment under the following scenarios. So if the problem statement is understood, I'll just summarize it for the benefit of all. So I've sold shares. The agreed consideration is 100 crores, 50 crores to be paid upfront, 50 crores to be paid next year contingent on some event. Let's say the contingency is that my profit should have reached X number, my turnover should have reached X milestone. If those contingencies, or if those milestones are met, only then I get my balance 50 crores, else I will not get my balance 50 crores. So how do you handle this? It depends on what is the position on the date of filing. By the date of filing, if you have clarity on whether that balance 50 crores is receivable or not receivable, then it's an easy decision to make. So there again, there are two possibilities. On the date of filing, the second installment is certain to be paid to me. In fact, it has been received by me in year 2. But the question here is, do I offer this second lot of 50 crores in year 2 or year 1?
If it is an accrual basis, year 1. It is a receipt basis, year 2.
Accrual basis, even under accrual basis,
Yeah, because
when does income accrue? What do you mean by accrue? Accrual is your right to receive. My right to receive accrues or arises in year 2 when I meet the milestone. Only because I meet the milestone, I have the right to receive the balance 50 crore. Because the milestone is met in year 2, can I say the income is accrued in year 2 and I offer to tax in year 2?
No, year 1 only we have to.
Year 1 only.
Yes.
What does the agreement say about what happens if the profit target is not met?
Then the balance 50 crore will not be paid.
But the first 50.
Yeah, because then we are actually applying the buying day rate and the selling rate.
The client is going to be very unhappy with you, sir.
Yeah, but that is the case.
Yeah, but we are not here to distribute sweets. Okay. Any support for option 1? Sir, at the back. Here.
As for 115, I think the capital gain has to be first calculated in the foreign currency and then to be transferred to the Indian currency.
If you read 115, I'll just read the relevant portion. Basically, rule 115 gives you the methodology for computing gains in INR where the gain is denominated in a foreign currency. It gives you the basis as to what exchange rate is to be adopted. So rule 115 says, rate of exchange for the calculation of the value in rupees of any income or accruing arising in foreign currency shall be as under. So that it gives you dates as on when you will adopt the exchange rate given to you by SBI. So you have to go to State Bank of India, take the telegraphic transfer buying rate of a certain date. What date is what 115 tells you? In respect of income chargeable under the head capital gain, the last day of the month immediately preceding the month in which the capital asset is transferred. So we are not too concerned with the dates. It's telling us the last day of the previous month in which the transaction happened. We are not concerned with the dates. We are concerned with the fact that Rule 115 tells us to convert the income into INR. So it's an indicator that you will first compute the income in foreign currency, that is option 1, and then convert it into INR. So this is where you find support for option 1. We also have a jurisdiction of High Court judgment. Jay Kumari and Dilhar Kumari. Similar set of facts. We will not get into the facts, we will get into what the court had to hold. Rule 115 must necessarily be followed in computing the capital gains or loss as the case may be. So it's a mandate, it's not an option given to you. You have to compute your gain in terms of Rule 115. The revenue is bound to apply the exchange rate uniformly for the purpose of computing the capital gains or loss, formally devised by the legislation in terms of Section 48. So Section 48 read with Rule 115, you have to apply uniform exchange rate. So mathematically, if you've noticed, the key difference between option 1 and option 2 is, under option 1, both the purchase and sale are getting converted into INR on the sale rate at 83. Under option 2, I am converting the sale at 83 but the purchase at 63, which is why I am getting the gap. Right? So here, court says you have to apply exchange rates uniformly. Capital gain is supposed to be modified in the manner indicated. That is calculating, so the revenue had gone ahead and passed an assessment order calculating in terms of option 2. High Court is now directing capital gain has to be modified in the manner indicated. That is calculating the capital loss at the exchange rate prevalent on the date of sale in terms of Rule 115 and allowing a capital loss of 42 lakhs 33,000. In clear express terms, Karnataka High Court has supported Rule 115 computations, has supported option 1 computation. Still anybody who want to favor option 2? There's something very fundamentally missing in this entire analysis. I'll come back to the High Court judgment in a while. Before that, let's take a much simpler example. This was a complicated example involving indexation, involving currency appreciation, involving asset appreciation. We had 3 parameters in our computation. Let's eliminate 2. Let's eliminate indexation, let's eliminate asset appreciation, and only look at an example where there is a currency appreciation. Consider a case of short-term gain. Cost of share say $100. Selling price also say $100. Right? So the asset value is not appreciated. But then exchange rate on the date of purchase was 80 and the exchange rate on the date of sale has now become 85. Now look at a computation under option 1 and option 2. Under option 1, when I am computing my gains in foreign currency, I get nil as taxable income. Under option 2, I am getting 500 as taxable income. This 500 is nothing but the currency appreciation. From 80 to 85, that 5 rupee currency appreciation into $100 is what? Haven't I actually earned it? Is it not real income in the hands of the SEC? Is currency appreciation exempt anywhere under that? It is in certain scenarios. Look at first proviso to section 48. There is an exemption from currency appreciation to a non-resident investor. We looked at an outbound transaction. Look at an inbound transaction. Let's say a non-resident investor is buying shares worth $1,000 and he's selling it at $1,000. And between there is a currency fluctuation resulting in an INR gain of 15,000. In terms of USD per se, he's earned nothing, he's gained nothing. But if you compute in INR, there is a gain of 15,000, but then the first proviso to section 48 specifically exempts the non-resident from this. First proviso to section 48 specifically tells you don't compute in INR, compute in USD, don't pay tax on the 15,000. There is another instance. Look at fifth proviso to section 48. Fifth proviso to section 48 will tell you any gain arising on account of appreciation of rupee against the foreign currency at the time of redemption of a rupee denominated bond of an Indian company, it shall be excluded from computation of gains. So wherever legislature intended to exempt currency appreciation, it has done so by express provisions. The fact that there is no relaxation in the case that we are currently handling, to me is an indicator or is conclusive that it needs to be taxed. Doesn't this sound a little absurd? If I'm to follow option 1 and say I will pay no tax despite me having actually earned 500, isn't it something that we find it difficult to digest? Rule of the law has to be read as it is. Rule 115 says so, we follow so. And moreover, we have the blessings of Karnataka High Court, jurisdictional High Court. The dictum of the Karnataka High Court is binding on the SSC as well as the assessing officer. But then please note, the Karnataka High Court judgment is a judgment which was issued for assessment year 73-74. A year where the concept of indexation was not part of the Act. Indexation came into the Act from 93-94. Now look at what you are actually doing under option 1. You are applying cost inflation index to foreign currency. Now how is cost inflation index computed? Cost inflation index is computed here by referring to Indian inflation rates. The inflation rates in India are significantly higher than the inflation rates that you see in US. So applying Indian inflation rates to US asset is not the intent of providing you the benefit of indexation. 1. 2. Coming to Rule 115. Rule 115 is only supposed to be a methodology to quantify your taxes, quantify your income, and not a medium to exempt any incomes. Section 48, 45, to my mind, levies a complete charge, including on this currency appreciation, which cannot be discounted by 115. 115 is subordinate to the Act. It cannot take away anything which is provided in the Act. It cannot give you anything additional other than what is given to you in the Act. And therefore, the right view in my mind would be pay tax on 14,35,800. The client wants to take this risk. And anyway, you have a High Court judgment also, so they can't give penalties for misreporting, underreporting because you are relying on a jurisdiction of High Court. So you may as well go ahead with 13,77,800 as well.
Even in the option 1 also, the amount credited or bank account is, what is the amount?
Correct. The amount credited is 16,18,500.
Yeah.
And amount that I have actually paid is 2,000 into 63.
Yes.
That is my actual cost of acquisition. Even if looked at it from that point of view, what is my actual cost and my actual sale consideration, it would favor option 2 rather than option 1. I think we'll stop here. If there are any queries, I would be happy to take them now. Else, the session stands concluded. I thank you all for a very patient hearing. I sincerely hope that there has been some addition beyond mere CP credits. Thank you.
Thank you, Deepak, for enlightening us to that session on capital gains. On behalf of the Managing Committee of Bangalore Bank, I request CA Prakash sir to give Mr. CA Deepak a token of appreciation from our end. Thank you, Mananal. Have a nice evening.
Yeah, because then we are actually applying the buying day rate and the selling rate.
The client is going to be very unhappy with you, sir.
Yeah, but that is the case.
Yeah, but we are not here to distribute seats. Okay. Any support for option 1? Sir, at the back. Begin it.
As for 115, I think the capital gain has to be first calculated in the foreign currency and then to be transferred to the Indian currency.
If you read 115, I'll just read the relevant portion. Basically, rule 115 gives you the methodology for computing gains in INR where the gain is denominated in a foreign currency. It gives you the basis as to what exchange rate is to be adopted. So rule 115 says, rate of exchange for the calculation of the value in rupees of any income or accruing arising in foreign currency shall be as under. So it gives you dates as on when you will adopt the exchange rate given to you by SBI. So you have to go to State Bank of India, take the telegraphic transfer buying rate of a certain date. What date is what 115 tells you? In respect of income chargeable under the head capital gain, the last day of the month immediately preceding the month in which the capital asset is transferred. So we are not too concerned with the dates. It's telling us the last day of the previous month in which the transaction happened. We are not concerned with the dates. We are concerned with the fact that Rule 115 tells us to convert the income into INR. So it's an indicator that you will first compute the income in foreign currency, that is option 1, and then convert it into INR. So this is where you find support for option 1. We also have a jurisdiction of High Court judgment. Jay Kumari and Dilhar Kumari. Similar set of facts. We will not get into the facts, we will get into what the court had to hold. Rule 115 must necessarily be followed in computing the capital gains or loss as the case may be. So it's a mandate, it's not an option given to you. You have to compute your gain in terms of Rule 115. The revenue is bound to apply the exchange rate uniformly for the purpose of computing the capital gains or loss, formally devised by the legislation in terms of Section 48. So Section 48 read with Rule 115, you have to apply uniform exchange rate. So mathematically, if you've noticed, the key difference between option 1 and option 2 is, under option 1, both the purchase and sale are getting converted into INR on the sale rate at 83. Under option 2, I am converting the sale at 83 but the purchase at 63, which is why I am getting the gap. Right? So here, both says you have to apply exchange rates uniformly. Capital gains was to be modified in the manner indicated. That is, calculating, so the revenue had gone ahead and passed an assessment order calculating in terms of option 2. High Court is now directing capital gain has to be modified in the manner indicated. That is, calculating the capital loss and the exchange rate prevalent on the date of sale in terms of Rule 115 and allowing a capital loss of 42 lakhs 32,000. In clear express terms, Karnataka High Court has supported Rule 115 computations, has supported option 1 computation. Still anybody who want to favor option 2? There's something very fundamentally missing in this entire analysis. I'll come back to the High Court judgment in a while. Before that, let's take a much simpler example. This was a complicated example involving indexation, involving currency appreciation, involving asset appreciation. We had 3 parameters in our computation. Let's eliminate 2. Let's eliminate indexation, let's eliminate asset appreciation, and only look at an example where there is a currency appreciation. Consider a case of short-term gain. Cost of share, say $100. Selling price also say $100. Right? So the asset value is not appreciated. But then exchange rate on the date of purchase was 80 and the exchange rate on the date of sale has now become 85. Now look at a computation under option 1 and option 2. Under option 1, when I am computing my gains in foreign currency, I get nil as taxable income. Under option 2, I am getting 500 as taxable income. This 500 is nothing but the currency appreciation. From 80 to 85, that 5 rupee currency appreciation into $100 is what? Haven't I actually earned it? Is it not real income in the hands of the SEC? Is currency appreciation exempt anywhere under that? It is in certain scenarios. Look at first proviso to section 48. There is an exemption from currency appreciation to a non-resident investor. We looked at an outbound transaction. Look at an inbound transaction. Let's say a non-resident investor is buying shares worth $1,000 and he's selling it at $1,000. And between there is a currency fluctuation resulting in an INR gain of 15,000. In terms of USD per se, he's earned nothing, he's gained nothing. But if you compute in INR, there is a gain of 15,000, but then the first proviso to section 48 specifically exempts the non-resident from this. First proviso to section 48 specifically tells you, don't compute in INR, compute in USD, don't pay tax on the 15,000. There is another instance. Look at fifth proviso to section 48. Fifth proviso to section 48 will tell you, any gain arising on account of appreciation of rupee against the foreign currency at the time of redemption of a rupee denominated bond of an Indian company, it shall be excluded from computation of gains. So wherever legislature intended to exempt currency appreciation, it has done so by express provisions. The fact that there is no relaxation in the case that we are currently handling, to me is an indicator or is conclusive that it needs to be taxed. Doesn't this sound a little absurd? If I'm to follow option 1 and say I will pay no tax despite me having actually earned 500, isn't it something that we find it difficult to digest? Rule of the law has to be read as it is. Rule 115 says so, we follow so. And moreover, we have the blessings of Karnataka High Court, Jurisdictional High Court. The dictum of the Karnataka High Court is binding on the SSC as well as assessing officer. But then please note, the Karnataka High Court judgment is a judgment which was issued for assessment year 73-74. A year where the concept of indexation was not part of the Act. Indexation came into the Act from 93-94. Now look at what you are actually doing under option 1. You are applying cost inflation index to foreign currency. Now how is cost inflation index computed? Cost inflation index is computed here by referring to Indian inflation rates. The inflation rates in India are significantly higher than the inflation rates that you see in US. So applying Indian inflation rates to US asset is not the intent of providing you the benefit of indexation. 1. 2. Coming to Rule 115. Rule 115 is only supposed to be a methodology to quantify your taxes, quantify your income, and not a medium to exempt any incomes. Section 48, 45, to my mind, levies a complete charge, including on this currency appreciation, which cannot be discounted by 115. 115 is subordinate to the Act. It cannot take away anything which is provided in the Act. It cannot give you anything additional other than what is given to you in the Act. And therefore, the right view in my mind would be pay tax on 14,35,800. The client wants to take this risk. And anyway, you have a High Court judgment also, so they can't give penalties for misreporting, underreporting, because you are relying on a jurisdiction of High Court. So you may as well go ahead with 13,77,800 as well.
Even in the option 1 also, the amount credited or bank account is, what is the amount?
Correct. The amount credited is 16,18,500.
Yeah.
And amount that I have actually paid is 2,000 into 63. Yes. That is my actual cost of acquisition. Even if you looked at it from that point of view, what is my actual cost and my actual sale consideration, it would favor option 2 rather than option 1. I think we'll stop here. If there are any queries, I would be happy to take them now. Else, the session stands concluded. I thank you all for a very patient hearing. I sincerely hope there has been some addition beyond mere CP credits. Thank you.
Thank you, Deepak, for enlightening us to that session on capital gains. On behalf of the Managing Committee of Bangalore Bank, I request CA Prakash sir to give Mr. CA Deepak a token of appreciation from our end. Thank you, one and all. Have a nice evening.